Are you finding it difficult to be a disciplined investor because of your profession, untimely payouts by your clients, or you could be facing some issue with your employer? Whatever may be the reason, if you are unable to systematically put money aside every month, what are the options that you can consider to amass wealth? Everybody wants to retire rich, but it can only happen if you let your money compound. So, what are the ways that can aid the wealth creation for your post 60 life? Let's find this out from Aditya Shah, Chief Investment Officer, GST Investment. Aditya, good evening. Welcome to the show. How should a retirement portfolio look like?
Good evening, Kavita ji. As you rightly said, if somebody lacks the discipline, there are three or four products that are really available in the market, which all these investment managers have tried to address. Number one is retirement funds that mutual fund companies have launched. So what these retirement funds basically do is they have a lock-in period of 5 years. Uh, and basically, the idea is to cater to your pension needs when you really retire. They can be aggressive or they can be not so aggressive and conservative, where the equity allocations on these funds varies with the debt allocation. That is product number one, which is called retirement mutual funds, where they invest in debt and equity as per the mandate of the mutual fund. You can go ahead and invest in these mutual funds. However, there will be a lock-in of 5 years in these. The other product that you can invest in is called the National Pension Scheme, where you can invest uh, at any point in time, and you will get the benefit of it when you retire at the age of 60. The third product that is available is the Provident Fund. As we know, we have EPF and we also have Personal Provident Fund. In all of these products, the advantage is you get some tax benefit or the other. For example, on the retirement mutual fund, it is exempt under Section 80C of the old tax slab. On the NPS, it has got 50,000 of tax exemption under Section 80C CD2, and we already know the exemptions that are available on EPF and EPF. So these are the three products that are genuinely available for retail investors to go ahead and invest. I will suggest keep continuing to invest in all of these funds. And by chance, if you have time, try to create a financial plan and try to plan, even though your life may not be planned. However, the best you can do is good for us because if you are able to invest systematically into these products, even if it is not a SIP every month, you will be able to generate returns over a long period of time.
Aditya, let's talk about the retirement funds that are launched by mutual funds houses. Uh, let's compare it with a normal active fund, a well-diversified active fund, and a retirement fund. What is the difference in terms of exposure, investment strategy? Obviously, you have a tax benefit if you talk about a retirement scheme from an AMC if you buy one. But otherwise, what is the difference when it comes to the investment strategy, style of investment, and also because we're talking about your retirement strategy, you have a longer duration. That is what we assume a fund to also give you the benefit of a longer duration. How do they operate?
Definitely. A well-diversified mutual fund will have a mandate to compulsorily invest most of their allocations to equities, or sometimes they will take cash calls. However, on the retirement funds, that's not the case really. For example, an aggressive mutual fund, the aggressive retirement fund can invest in equities as well as a little bit of debt. This is equivalent to having a sort of balanced fund in your portfolio. Or you can have a very conservative fund where the conservative fund will invest across the debt markets and some portion of it will be invested in equities. So the benefit is since the lock-in period is 5 years, the fund managers do get the funds for at least 5 years of lock-in, so the fund manager can properly invest. However, these are not purely personalized to investors needs. However, the AMCs have tried their best to give a product for people who have not planned properly. And I will say that those who have not planned properly, they can go ahead and invest in retirement mutual funds. However, given a chance, I would advise them that since they are not personalized to investor needs, try to create a plan and then go ahead and see where it can invest.
Schemes or retirement funds that you would recommend one to invest into and why?
Sorry, can you repeat that?
What are the retirement funds that you would recommend one to invest in and why?
SBI has got some good retirement funds, the aggressive one and the conservative one. Both of them are doing extremely well over the last 4 or 5 years. That is another one. The HDFC retirement fund is also doing extremely well. You can go ahead and invest. Again, my advice to all clients will be only if you cannot plan and you don't have time, go ahead and invest in these funds. However, if you do get at least certain amount of time, please plan properly and try to see how you can plan for your retirement and what is the goal, what is the amount of money that you require. However, the three funds where you can invest in, I have already given you.
So quickly, what also people do actually is they think that they have their money put up in the EPF, PF, and the PPF and other instruments which are tagged as retirement products, and they don't think it's important to go beyond that investment instrument. How wrong is it?
Ma'am, all these instruments that you just talk about, PF or EPF or NPS, they may have only debt corpus inside their portfolios. So what it really does is you can only generate returns about 6, 7, 8%, and you will not generate a return higher than that. It is very important to beat inflation in the long run, and the only asset class that can beat inflation consistently over a long period of time is equities or the share markets or the mutual funds who invest in shares. So you have to diversify across all asset classes. Only invested in debt products will not justify the returns that you will get. So therefore, I will suggest create a portfolio of equities, debt, real estate, and gold, and invest accordingly. You will get a blended return of somewhere between 10 to 12%. And if you're able to do that consistently for the period of next 10, 12 years, you will surely be able to meet your retirement goals.
All about retirement planning that we just spoke about, but now we have to move on to viewer queries. So Aditya, first question for you comes from Sanket Kadam, and he says that his focus is to retire at 60. He wants to understand what are the options of investments in mutual funds. He wants to generate a corpus which is around 2 crore 50 lakhs, and that is the aim for retirement that he is planning to achieve through the investment portfolio that you would guide him for. He is 38 right now, and he obviously he says that he is planning to expand his family also. Current monthly expenses, which includes his household expense and recreational cost, is around 30,000 per month, and monthly income is 65,000, and he can invest 2,500 per month in mutual fund schemes. As of now, what he says is he has an RD of 10,000 only, and no liabilities so far.
Ma'am, given this goal of 2.5 crore in about 22 years' time, which is his retirement time, he will need to do an SIP into equity mutual funds of minimum 20,000. I have assumed a return of about 10 to 12%. So minimum 20,000 he will need to do an SIP. So that means that the money that is going to an RD must be redirected towards a equity mutual fund. That's the second one that I want to say. The mutual funds that he can invest this 20,000 is Parag Parek Flexi Cap Fund, UPI Nifty Next 50 Fund, and BSP Quant Fund. Over the next 22 years, you have to invest in these funds in a very disciplined way, in a very consistent way. When the market goes down, don't panic. When the market goes up, don't be too euphoric. If you're able to consistently invest in these funds, you will be able to generate the 2.5 crore corpus that you have set out in the next 22 years.
All right, next query, and that's from Priyanka Salukhe, and she wants to know for how long should one hold in gilt funds. So before you give her the answer to her, please help us understand what are gilt funds actually.
Good question. Gilt funds are securities that are issued by the government of India. Since they are issued by the government of India, they have very negligible default risk. So that therefore one of the risks goes out of the system, and you only have to worry about the time risk of the money that you have lent. That is the first point. The second point is today many retail investors feel that if they invest in long-term gilt funds, they will be able to get spectacular return. However, that is not possible as the interest rates keep moving up. The value of these bonds will continue to move down, and some of them will give negative return. So what a retail investor has to do is invest first of all in very short term gilt funds. The second point is how long you have to hold them. You have to hold them till maturity. If you hold them till maturity, you will get the amount of return that is given on the yield fund. For example, today the yields are ranging on a 10-year yield fund somewhere between 7.1%. So if you are able to consistently hold it for 10 years, you may be able to get the 7.1% yield. However, I will strongly advise that don't go for longer duration yield funds. Go for about 1 or 2 years because interest rates are rising and longer duration yield funds will start to give negative.
What kind of a risk appetite one should have to invest in gilt funds?
Ma'am, low risk individuals can also invest in gilt funds. However, they must know which end of the gilt fund to invest in, either the shorter duration or the longer duration. Since credit risk is out of the system, one of the major risks is taken care of. Therefore, low risk investors can also invest in these funds. However, right now at this stage, interest rate risk is prevailing in the system. Therefore, I have suggested that we add the shorter duration of the gilt fund, whereby interest rate risk will not be there.
All right, so that's all with the viewer queries that we have for now, right? For you, Aditya, thank you so much for making time and helping people achieve their financial goals.